Welcome to the Commercial Credit Corner podcast with your hosts, Qualtik CEO Mark Pryor and Qualtik President Mike Fletcher, here to give bi-monthly commercial lending and credit insights to help community bankers manage their loan portfolios in an ever-changing economic landscape. Based out of the Qualtik offices in the beautiful Portland, Oregon, we look forward to diving into current events with some exclusive insights from the experts in the industry.
Okay, Mark, are you ready to jump into the news?
I'm ready.
First up comes from Mike Simuth in the article from the Commercial Observer. The title of the article is Lenders, especially banks, are starting to sell a lot more loans on office buildings. And a few of the highlights from the article include that Canadian Imperial Bank of Commerce agreed to sell $316 million of loans on office buildings in Austin, Phoenix, Seattle, and San Francisco at a discounted price. And that was according to the Financial Post. And then also in the last couple of weeks, Bloomberg reported investment bank Morgan Stanley plans to buy $700 million of commercial real estate loans from a group including Blackstone, Rialto Capital, and the Canada Pension Plan Investment Board. The CRE loans have been on the books from the failed Signature Bank, and the article quotes estimates from Yardi related to the debt service coverage ratio for office buildings. They are averaging below the typical 1.25 threshold in 13 of 91 U.S. markets, including Manhattan, which is at 1.05, Chicago at 0.9, and Oklahoma City at 0.89. Mark, I know transactions of loans is a space you've had a lot of experience. What are the drivers that lead to asset sales at times like these?
It's a couple of things. One is concentration. It depends on how a financial institution is concentrated relative to certain commercial real estate types and whether or not they need to remove some of those concentrations and send those to institutions that want larger concentrations. The other thing is distress in a portfolio, either coming stress from a loan reset or current stress, whether it's payment or some compliance issue or something that the bank really looks at their portfolio and says this doesn't need to be on our books anymore. The fact that transactions have ticked up is not surprising. Something that's interesting is it really isn't transacting in a broad secondary market. These transactions are B2B, financial institution to financial institution, which means that they're not fire selling, which means that they are negotiating sales between other financial institutions to get it off their books. That bodes well now. That could change. Obviously, the debt service coverage ratios in some of those cities is Oklahoma City is really surprising to be there. So that is trending concern. Fortunately, that was only 9 of the major markets that was there, but it is a trend that's worth watching.
Yeah, it does seem to be market by market, as we might expect. And it is interesting to see those additional transactions starting to take place. So next up comes from Eric Sherman in an article from globest.com titled Economic Activity Expanded, but CRE Softened, the Fed says. The article points out that conditions in the commercial real estate sector have softened amid supply concerns, tight credit conditions, and elevated borrowing costs. In Atlanta, CRE conditions were mixed. Office and multifamily continued to slow, with multifamily and industrial oversupply from new construction delivery weighing on market conditions. Vacancy rates were up, and rising insurance costs interfered with activity, especially in coastal markets. In Kansas City, some moderately good news was that after several quarters of decline, multiple CRE markets stabilized, albeit at low levels. That said, increasing vacancy rates pushed rents down. Sales were up moderately with slight increases in transaction prices. And then in San Francisco, CRE was largely flat, which is a change. Retail demand was up, leading to lower vacancies and higher rents. New CRE construction was stable, and builders continued through the backlog of existing projects. So, Mark, we seem to hear more about new construction inventory and a certain level of stabilization occurring in some markets. But when we pair that with the well-documented wave of maturities and repricing on the horizon, do you think it's the calm before the storm, or are things starting to stabilize?
I, I tend, and some of this is just instinct, some of it is data driven. I think that for 4 years we've been hearing the storm is coming. I think this is it. I'm hopeful. I'm hopeful this is what the storm is. That there's going to be some pain, particularly in some markets that are oversaturated. However, a lot of this stuff has been absorbed. There are resets coming, but a lot of this has already been absorbed and accounted for. So I'm hopeful that the next few years have some pain, but with the continued growth in the economy, the continued strength of the economy, that's sort of washing some of that out. And, the Fed is hinting, and we've been hearing this for a year now, but the Fed is hinting that interest rates are going to start coming back down, and that will help alleviate some of this. Look, there are going to be markets that suffer, and clearly with some of what's going on in some markets, there are going to be pain and transactions of CRE financial instruments within those marketplaces. But I am generally, for the overall market, optimistic that we may be in what the trough is right now, with some more pain to come, but not catastrophic pain, manageable pain.
Fantastic. Coming off the heels of that comment, let's talk a little bit about loan delinquency numbers. And again, this article comes from Eric Sherman and theglobest.com in an article titled CRE Loan Delinquencies Growth is Slowing. And it points out that growth in commercial real estate delinquencies slowed for the second consecutive quarter as high interest rates continue to pressure borrowers, while banks emphasize that stress remains concentrated in the office sector. Overdue commercial real estate loans across U.S. banks increased 10 basis points to 1.25% in the first quarter, according to data from S&P Global Market Intelligence. While that represents a new cycle high, the increase was less than the increase of 11 basis points in the fourth quarter of 2023 and the increase of 21 basis points in the third quarter of 2023. On this same topic, I'll point out that TREP podcast, episode 261, did a nice job of explaining that while the net number for delinquent loans is softening, a material part of that is due to loans moving into the loan loss category. So kind of referencing back to that article that we talked about earlier. Do you have any other thoughts around these delinquency numbers and what those represent, Mark, as they seem to be slowing a little bit and softening?
Yeah, it goes back to my earlier comment that a strong economy, which is by many measures still very strong in lots and lots of sectors, is easing the pain. I think in commercial real estate that recognizes some of that softness. There are sectors of commercial real estate that still, office in particular, from a vacancy and occupancy perspective. But it's encouraging that those numbers are softening relative to delinquencies. Again, we have some pain to go. There's no doubt about that. There's a lot of this stuff to sort out. But I go back to this. There's been lots of catastrophic warnings about what was coming. I just don't see that. I just don't see it as catastrophic, but I do see it as painful. And nothing that our banking system can absorb, and certainly nothing like, it wasn't commercial real estate land, but certainly nothing like the financial crisis of 2008 is on the horizon. I'm just optimistic there's a very slim chance that that's even a possibility.
Yeah, it's encouraging, isn't it? A lot of these numbers seem to be indicating that. Well, I'm looking forward to your conversation with Hope Lunt coming up. It's such a great background in the banking sector, and we'll kick it over to that interview.
It's my absolute pleasure to introduce you to Hope Willard Lunt. She is an investor and advisor to Qualtik, and she is also currently the managing partner of Spence Limited LP, which is a financial services hedge fund that invests in community banks throughout the U.S. Before she joined Spence Limited, she managed financial services investments for UBS O'Connor Hedge Fund Group. She also serves as a member of the board of directors of Cecil Bank Corp., Gateway Bank, FSB, Signature Bank of Georgia, and White River Bank Shares, amongst others. She received her degree from Vanderbilt University, and I'm very excited to have her on our first podcast. It's my pleasure to introduce you, everybody, to Hope Lunt. As I said in the opening, Hope is an investor and advisor to Qualtik, amongst many other things. And we're excited to have her as part of our first podcast. As I was telling her before this started rolling, I was really excited that she agreed to do it first, because Hope has really deep insight, understanding into the exact things we're doing for banks. And she's been a big help for Qualtik to be where it is today. We're excited to have her on this podcast. And I know obviously what you're doing today, and I know where you grew up, but am I right? You grew up in Memphis, correct?
Northeast Arkansas, just across the bridge from there. Yes.
In Jonesboro?
Forest City, Arkansas.
Okay. Well, my father-in-law is from Jonesboro. So
there you go. Small world.
Yeah. Yes, it is. And so you graduate from high school, you go to school in Nashville, correct?
Correct.
What made you choose Vanderbilt over somewhere else?
We came through Nashville when I was a middle schooler, 7th, 8th grade, something like that. And I just decided, we drove by Vanderbilt. It's right in the middle of town, as most people probably know. And we didn't even go onto the campus. We drove by there, and just something struck me. And I decided at that very moment I was going to do everything I had to do to get to go to Vanderbilt. And that I worked really hard and managed to get there.
And when you graduated, did you stay in Nashville?
I did. My very first job I got hired out of Vanderbilt was to work for a little regional brokerage firm, J.C. Bradford. And at the time, the gentleman covering the banking sector, Henry Coffey, needed some help. And that's how I started learning about the banking industry.
So what led you to the banking industry? Why did you decide that?
Well, frankly, it had more to do with what J.C. Bradford needed a junior analyst to do than what I really sought after at that point. I had one goal as I finished up at Vanderbilt, which was to not return home to Forest City, Arkansas. And I didn't even realize a job analyzing stocks for a living really existed at that point. And when they came on campus and that's what they were looking for, I thought, that sounds pretty cool. And I thought it would be a good fit for what my interests were. And I'm the luckiest person I know, frankly. I got a chance to be introduced to a career path that I'm still, frankly, on the same journey I started on 31 years ago at this point. So I'm very lucky that way.
That's pretty neat. Boy, you've seen Nashville change in your time there.
Wow. I was thinking about that the other day. I was downtown yesterday for a meeting, and there were a couple of things going on 2nd Avenue 30 years ago, but gosh, anyway, lots have changed. Lots of good stuff. It is remarkable. I agree.
Until I came there, I think when I met you 3 years ago, I hadn't been in 7 or 8 years, and just in that intervening period, the skyline, how much it had changed. The growth is pretty incredible, and there's good and bad to that, as with all things. But Nashville's done a pretty good job of managing growth and attracting good talent, kind of becoming what Atlanta was in the 80s and 90s, kind of a mecca for finance. And
yep.
So how did you end up at Spence?
So during my time at J.C. Bradford, I was writing some research on community banks, and I got a call one day. This will speak to naivete and how life was a little different maybe 30 years ago than it is today. I got a call. He introduced himself as John Spence, and that, he looked at community banks too, and if we were both going to be in Nashville, we ought to know each other. I said, well, that sounds fine. He's like, I'm going to pick you up tomorrow for lunch. I'll be the guy in a Hawaiian shirt and a convertible. And for some reason, 24, 25-year-old Hope was just like, okay, I'll see you then. And here we are almost 30 years later since I had the pleasure of meeting and getting to know him. So at that point, I became an investor with him, and we would talk all the time about what we were seeing in the banking industry. And then about 10 years ago, after I'd had my son and he was ready to do a little bit less. He's a bit older than I am, and it was just the right time for us to work together. So here we are, a little over 10 years later, and I've been managing this product that he started 35 years ago now.
And you work with banks all over the country, obviously.
Coast to coast these days, yes.
So it's interesting for me, too, having grown up in basically the same South. I grew up in rural Georgia. I know it's hard when I talk to tell that, but
I have a similar problem, yes.
It just, here it is. It just doesn't go away. Is that the differences and the similarities in community banking nationwide? As you think about how banks, let's take banks under $10 billion.
Okay.
If you're thinking of a West Coast bank versus an East Coast bank, are they generally the same DNA? Are there differences geographically, or are banks, just relative to the people that are in them oftentimes?
Well, the people always make a mix of one sort or another, right? They're going to take on the personalities of, particularly when you're dealing with younger banks where you have the founders still involved, right?
Right.
But the mission is the same, whether you're in San Francisco or Boston. I happen to be involved in banks in kind of both of those cities right now. You want to serve the client. You've got to come up with a differentiated way to serve the client, right? If they're going to bank with you, if they're not going to bank with one of the universal banks, then that small mid-sized client is looking for something else, right? And you got to come up with a way to serve them the way they want to be served.
Yeah, that's an important note, is that community banks particularly, I always say this, they are the lifeblood of what makes towns tick, like communities tick. No question about it. Without them, you're not distributing SBA loans in a significant way. You're not getting working capital out to people, to businesses, to individuals. And finding that community banks generally, because we serve banks coast to coast, what we find, generally speaking, is the ones that are successful are the ones that are heavily plugged into understanding what their community needs and lend to that profile versus a profile that they have set for themselves. And there are plenty that do that will try to lend to a profile that's not set for the community with which they are, and they tend to be tone deaf around those kind of things. But the ones that are really successful understand their markets deeply and who they serve.
Listen, I don't think you get much more more service-based business than community banking.
Agreed.
That is what they've got to sell, right? And I think inherent in that is providing the services that market needs, right? I think
right.
I couldn't agree with you more on that front. I mean, if it's not what the market needs, then why are you bothering? Right.
Well, I don't know, and I'd love to get your perspective on this. There's obviously in the last 15 years been a rash of consolidations. Banking has continued to fewer and fewer numbers of banks. Obviously,
Yep.
banking dollars grow. What impact do you see that having in markets? What do you, in particularly in markets in which you work and in which you understand and in which you're invested? What's the impact of that then?
Well, I think we're just starting to maybe feel some real impact from that, right? I think we still have lots of banks. Despite all the consolidation, we still have thousands of banks, right? And I think there are pockets, there are rural corners of the world where they don't have bank branches anymore, right? Maybe the one bank in town got acquired and over time that branch got closed. I would say those are the exceptions where you have very small areas that have managed to not retain any banking services. But, going back, just talking about Nashville, we got banks coming in that want to serve this market. More mid-sized banks, right? We haven't had a lot of de novo activity. We haven't seen de novo activity, period, frankly, in the last 10 years since the Great Recession. But we've got plenty of mid-sized regional banks that continue to reach this direction, right? So I think it's still too soon to answer the question you just answered, with the exception of some really small areas.
Yeah, I think Georgia in the last downturn sort of typified what was coming. Georgia has 159 counties, and almost every county had a bank.
The old unit banking laws, right?
And it didn't take much capital to start a bank. And so Georgia, with those small, hyper-fragmented banking markets, it needed consolidation, I think, to strengthen the balance sheet of a lot of those banks. And there was a lot of pain involved but I think the banking system overall is stronger, at least in my view. It's stronger now than it was in the last downturn because of some of that consolidation. Pulling balance sheets together, it's hard to survive as a bank lending to grow any significance and serving a very, very tight, small market.
I think that's right. I mean, to your point, I mean, Georgia was an era where we saw lots of de novo activity in the late 90s and the early 2000s. And those banks got started just in time to absolutely run into the buzzsaw of the recession. And
Right.
So I think, that was a tough recipe, quite frankly, to avoid at that point. And so, and when you think about it, this bank's getting started with handfuls of millions of dollars in capital.
$5 million. That's what we require. $5 million was the requirement to get a charter.
$6 million in capital. I mean, you have one or two loans go the wrong way on top of your typical startup losses in the first couple of years of opening a bank. And there's nothing left in fairly short order. And I mean, we saw that play through dramatically, right? Florida, Georgia were two areas that were particularly hard hit, as well as Arizona.
Bank markets with low capital requirements, and to your point, not a lot of reserve to endure losses. And nobody could have predicted what was coming. But some markets I think are underserved by community banks. Behind me, I'm in Oregon right now, and Oregon only has 15 community banks now. A state this size has 15 community banks, which is hard to believe in some ways. And it's served by regionals primarily.
Yeah.
Which is a different idea than that occurs in some parts of the country.
I think you're right. I mean, Oregon has seen a lot of that consolidation, absolutely, and it's probably your first real test of how markets can be impacted by that. I don't know. I still think we've got plenty of banking product coming to market at this point. I don't, like I said, that it would be the exception of the market that I would be worried about not having product. And then, as we look ahead and think about how we're going to deliver banking products, it may not be traditional banks delivering products to the extent we can do more and more electronically, right? So it'll be interesting to see how it all unfolds.
Well, it's been interesting from a technology perspective because I didn't come up in banking, but I certainly work in it now from what we're trying to create, what we're trying to do. And in the last 10 years, there's been a marked change in how banks view technology. That 10 years ago, you couldn't get them to talk about even having email not hosted on site. And every bit of software had to be hosted, and they wanted to close the system. And now we don't have conversations with any banks where they don't understand that what we provide in a SOC 2 Type 2 environment is much more secure than what it is they can provide. I think there was two things that drove that. One is banks are late adopters to technology, no doubt about it. So they're sort of catching now on the power of the things they can do if they're not hosting it. But the second is as the C-suite has gotten somewhat younger or somewhat more prone to adopt technology, banks have gotten much better at managing that. And frankly, it gives them a key competitive advantage when they do embrace technology in ways that's highly helpful, both from a customer perspective, but also a reporting perspective, management of capital, management of reserve. And obviously, with your 30 years in banking, how have you seen that technology shift occur, and what do you think's driving?
I would say that it's the same thing driving all industries, right? The need to be more efficient. I mean, banking is not a unique or terribly creative business, right? Commoditization, the process for commoditization is almost lightning fast in the banking industry. I think the benefit really is that the cost of technology has come down, right? I mean, the banks have historically not had the profit margins to be able to be on the leading edge of technology because that's usually the most expensive part of the cycle, right? But, as the cost of technology has come down and it's become more accessible to particularly small banks, they could take it on, right? And I think what I've been most impressed by is that they understand how it really can help them today in a way that even 15 years ago, to your point, they did not understand how helpful it could really be. And I wouldn't want to imagine what a pandemic environment would have looked like 15 years ago. With how we would have managed the sector and how we would have been able to continue to interact with clients and things like that. And so I'll give the banking industry some credit for being willing and coming around and really understanding the importance of technology and the role it could play in frankly their own survival, right? I mean, small banks today can provide just about any delivery of product or service that a mid-sized bank can. I mean, they're not going to do, foreign currency exchange like the Citis or the JP Morgans of the world do, but a good treasury management product is well within reach of the typical community bank, and frankly, that's what most of their kind of the upper end of the client base that they work with really needs is a good cash management product. Sometimes I think that's the benefit of being a small bank is that you don't have so much kind of embedded technology that you can't try something new and upgrade a product. It's a lot easier in a smaller organization to bring those products on.
Agreed. And it's been interesting to watch that arc. I think about community banks and giving them what really was an amazing thing during the pandemic to distribute PPP the way they did.
Yep.
Had that been 5 years earlier, I don't know if that would happen. But they were able to, much better than the large banks, most of that money was distributed through the community banking system. And they took something, a problem set they had never faced before. How do you distribute this much money in this short a time, not understanding rules, which, for a community banker, that almost short circuits them.
Yep.
But they embraced it as an industry and were able to distribute that money and inject a lot of liquidity, probably the most liquidity distributed at that level at one time into an economy in short order. And we're very efficient at doing it.
I have described it as a generational opportunity to prove their value to their clients.
Yes, no doubt.
I think there are banks that have earned clients for life because of the way they delivered that service so fast.
Compared to the majors, there's no doubt that I can tick off a dozen community banks that grabbed lifelong clients because of the way they backed during the PPP distribution. It was pretty amazing to watch.
I think history will only remember that time. The ability for the industry to pivot quickly. And they demonstrated the ability to understand they were in uncharted waters. And like I said, I have the pleasure of working with lots of community banks, and every one of the banks I worked with, at a moment when they could have just stuck their head in the sand and done nothing, everyone pulled together, and I thought did a really, frankly, extraordinary job for their clients.
I really do agree with you, and it's a testament. I don't know that they've gotten enough credit for what they did, but they were the distribution arm for injection of capital that was really needed at a time that people didn't know what was going to happen, and people were losing jobs left and right. They were able to inject money into the economy in a way that nobody could have said. If you'd have asked me 6 months ahead of that, laid out the situation and said, will this be a success in getting this money out? I'd have been hard-pressed to tell you I thought so, but I was wrong. They really stepped it up.
It's a good reminder that our economy can pull together and figure things out when it needs to. I think sometimes we get too caught up, these days in politics and whatnot, but when we really need to pull together, we can. And those are, I think that's what history will remember, quite frankly. I hope it is.
I hope so too, and I think you're right. So, to sort of wrap up, what advice would you give to community banks? What would you say to a community bank? Let's say someone's starting de novo, and other than don't do it, someone is starting
not the other way. No.
Yeah. Let's pretend like it's an ideal thing to do. What advice would you give to the founders to be successful?
It's a little bit about what we've already talked about. Know your market. Know what your market wants. For the handful of de novo banks that have gotten started over the last few years, one of the things I've looked for when I've been looking at them is how quickly have they been able to raise capital locally? Because that tends to be directly correlated with the need or the desire for the product in the market. And that to me is when you have a community that is willing to put the capital in to support a new banking venture, it's telling you that it needs it, right? And so that to me is, for someone contemplating starting a bank today, I would start with my circle of influence and work outward and see how, if you start with that idea, see if your hypothesis is right, because it should directly correlate with the amount of capital people are willing to write a check for to help you get it started.
Fantastic. Well, thank you so much. It really always is a pleasure to talk to you, and thank you for joining this podcast.
My pleasure. Thank you, guys.
Thanks.
Take care.
Thank you for joining us for the Commercial Credit Corner podcast, and we'll see you in the next episode.